G'day there, welcome to the weekly general update for the 1st and 2nd of July. Just a reminder, general information only in this video. Now a quick summary of the week, which was obviously finished on a incredibly positive note with that announcement out of Europe. I'm not sure what it really means, to be honest, in terms of tangible benefits, but the markets seem to like it. But this is going to take 6 months at least for the details of the deal to be worked out in Europe, and an awful lot can go wrong and an awful lot can happen between now and then. So I'm not really expecting that markets are going to go too far for too long. We might see a couple more weeks because we are coming into the US reporting season, which is generally you get a bit of a positive run-up before the start of earnings season, and then you tend to get a bit of a sell-off after that. So in terms of timing, we might see a rally for a couple more weeks into the middle of July, but I would expect after that we'll see downside. So looking at the S&P index for the week, net gained 27 points. It got fairly volatile there towards the end, and virtually all those gains, in fact there were more than that gains, that it was down on the week until Friday night, where it actually went up 33 points just on Friday night alone. I thought we had completed the three-wave counter-trend rally. That's probably not the case now. This changes the appearance of it just a little bit, not dramatically, and I'll show that when we get to the chart. But my view is still the same. When this counter-trend rally completes, we should see a five-wave decline in the impulsive direction, heading towards 1267 or 1207, or if things get really nasty in Europe, then we could go quite a bit lower. And as I indicated before, this liquidity deal, this European bank liquidity deal, just cannot be considered as a done deal at all. Now looking at the ASX 200, gained 46 points on the week. And there may be a bit more on Monday, but I'm not expecting a huge amount because a lot of it was already priced in on Friday afternoon. And there are many stocks that are in a very steady decline as analysts start to bring through earnings revisions downwards, and PE ratios start to fall as well. So when you start to get those two things together, where the actual earnings are falling and the PE ratios are falling, then you can see stocks lose 30, 40, 50, 60% of their share price fairly quickly. Now the US dollar index did fall sharply as the euro rose on Friday night, and that of course led to a very big rally in commodities. But to me, as we'll see from the chart, it's probably just a bit of noise, really. When you look at the chart, it's really just a lot of ups and downs, but the trend looks to be, in US dollar to me, looks to be up. Now bond yields in Europe reacted quite sharply with that deal, as you would expect. Spanish 10-year bond yields fell from nearly 7% again and came all the way back down to 6.33. So that was a very positive night for Spanish bonds. And Italian yields also fell from above 6 back down to 5.8. As a consequence, all the European stock markets rallied pretty hard. So let's just have a look at those few charts. This is the S&P 500 index, and the way that I've been labelling it up till now is we've had a five-wave decline which started on the 2nd of April. So wave 1, 2, 3, 4 and 5. So that really indicates that the main direction is down. So I'm looking for a three-wave counter-trend rally, which would have extended back logically to about as high as the 61.8% level, which is at 1363. Now we got to exactly that on the 19th of June, and I labelled this as a three-wave corrective rally. Wave 1 to here, wave 2, which was really only 2 days, and then wave 3. So that kind of made sense, and then I considered that this little decline that started on the 20th of June was the start of the five-wave decline to the downside, and that this could have been quite a significant decline. Now with this jump up, you've really got to relabel this now and say, well, this is wave 1, which runs up now to the 19th of June. Wave 2 completed on the 25th of June, and we're now in wave 3 to the upside. And I would be looking for probably 1390 as probably the maximum. If it goes above 1390, then we've got something completely different happen. So 1390 is the line in the sand. Anywhere up to there, I'm okay with as a 3-wave counter trend rally, and then I'd be looking for 5 waves to the downside. With targets, as I mentioned, down here 1267, 1207, and then other levels down here in the 1100s. So we'll just have to wait and see how it plays out. Now, as I mentioned, quite often we see a bit of market strength leading into the start of the earnings season. So if the US market, and that starts on the 9th of July. So if the US market continued to firm up for another week and a half, and then peaked out and started the decline from there, that would all tie in very nicely, both fundamentally and technically. So that's the setup. You can see on the RSI we're not yet overbought on the S&P, so another week and a half higher would also tie in very nicely with that part of the technical pattern as well. So we'll just have to see how it plays out. Now let's have a look at the US dollar index. You can see it's really been rising since this low point back here in October last year. Got a rise, big consolidation, another rise, and it went up to, then basically sat in this range between 81.5 and 83.5. Looked like we're heading back up again. We've had a sharp correction back down, but I want to see a break of this low here. We want to see a break of 81, a break and a close to say that the direction wasn't still to the upside. And of course the consequence of the US dollar continuing to firm up is that stock markets are likely to be weak, and commodity prices will certainly be weak as well. Let's have a look at our particular market. This is on a daily chart. You can see we did have a bit of a run on Friday, closed a bit off its highs, and the high point here was 4117. Our futures finished on Saturday morning at 4120, so the futures are only sitting just a fraction above the high point from Friday. So despite the very big rise in the US market, it would appear that quite a bit of that is already priced into the Australian market. So don't expect marvellous things on Monday morning, because it's pretty much already there. Let's have a look at gold. Gold was up $50 an ounce on Friday night, sharp move. And if we look at this on a weekly, you can see it's still holding above 1550, and we've now been there for about 7 or 8 weeks in that sideways range. It really needs to break above 1650, or if it breaks 1550, then I think we might be heading down another $100 or so. And silver also sharp move up on Friday night, as you would expect. So gold, a rise of $26 on the week, but $50 odd on Friday night. Copper had a big night, back up to $3.50, and it's been really, I've been reading a lot of commentators that are talking about how weak copper looks, but they must be looking at a different chart to me, because copper's been holding up very well for weeks, while oil and many other commodity prices have fallen quite sharply. And speaking of oil, it was a massive rise on Friday night, up 9% on light sweet crude, a huge rise. So we should see some very positive impact for some of the oil and gas stocks on Monday. Now this is a chart on copper, the 6-month copper chart. You can see it's not all that clear, but right over on the right hand side you can see the big move on Friday night, and we finished up here at $3.50. So in actual fact it's taken out the high of about a week and a half ago. So overall the strategy from here, the most likely scenario for me is that I think the euphoria over Friday's announcement will probably wear off pretty quickly. And the main reason that I say that is it's hard to see a win-win situation if it's going to be acceptable to both sides. One side, of course, being Germany, and the other side being Spain, Italy, Greece, all those guys. And I think whatever is acceptable to Germany will not be acceptable to those peripheral countries, and vice versa. So that's why I think getting this deal done over the next 6 months is going to be incredibly difficult. So I'm looking for perhaps a little bit more upside, 1375 to 1390 max, ramping up into the US reporting season. If it closes above 1390, then I'd have to rethink the pattern altogether. But then I'm looking then for a 5-wave decline that might then take us through August-September period. And following that, if that does work out, and particularly if it's that 5-wave decline ends up in quite a sharp fall, then I would expect a very substantial rally from oversold into year-end, because I can't imagine with elections that the US government is going to sit by and watch the stock market fall out of bed. So I think you'll see some actions by the Federal Reserve. So in terms of current exposure level, my position would be that minimal exposure is probably the order of the day at the moment. It's a little uncertain as to which way markets will go in the very short term. So predominantly I'm sitting without a lot of exposure, and I'm really looking for a setup to short sell over the next 2 to 3 weeks for the next phase in the market down. So that's the summary of the global and market action for the week. Talk to you next weekend. Cheers.